Good afternoon, everyone, and thank you all for joining us here. I'm just going to give it a couple of moments just to make sure that everyone jumps in that's here from the beginning. It's good to see you all. I can see some familiar faces there as well as new ones as well. Always good to see new people and returners. So do hope life has been treating you all well since we last saw you. It's been a couple of months, I think now. So can I just ask you all, can you just put something in the chat for me, please? Just so I know that you can hear me. I'd really appreciate that. Just put hi or anything you want, then I know that people are able to hear me. If you could do that. Okay, I think we've got a few people there that, yeah, everyone's waving. Lovely, thank you. Yes, a good old hi there from Mr. Woodsingham. So that's good. So, okay, we're going to be running a Q&A session at the end of this. So please do add your questions into the chat as we go. We're going to keep this webinar to a maximum of an hour. We usually go a little longer, but appreciate it's lunchtime. A lot of people have joined us during their lunch break. So any questions that we don't get to answer during this time, we will come back to you at the end of the webinar and answer those for you. So it would be really helpful to me as well if you could just tell me if your question is for Dale or Mike. That always helps me out. Okay, so I think we're about 5 past now. I'm just going to jump straight into it. So welcome to this Fabrik Invest webinar, and thank you to each and every one of you for joining us as always. The topic for the webinar is UK property market update. And as a company, we take our market research very seriously. And today we'd like to bring you up to date with what's happening in the industry, any changes that we foresee in 2022, and introduce you to some of our latest offerings. For those of you who don't know me, I'm Lynn Whittingham, and I'm delighted as always to be asked to host the webinars for the Fabrik Property Group. So for anyone who stays until the end of the webinar, we're giving away a free gift today. I know that Dale always tells me there's one gift at the beginning, and then at the end he surprises me and there's always 2 or 3. So we'll wait to see what he's given away today. But please do stop until the end for the opportunity to claim this. So without further ado, it gives me huge pleasure to introduce to you today from Fabrik Invest, the Managing Director, Mr. Dale Anderson, and from Fabrik Property, Dale always likes to jump in there. I tell him he shouldn't, but he does. And from Fabrik Property Group, Mr. Michael Bellini. So a quick introduction to Dale, as I know that most of you know Dale anyway and have been on our webinars previously. So Dale is the Managing Director of Fabrik Invest and has previously been involved with over £1 billion worth of off-plan transactions. Dale has over 15 years of experience in the industry, and his insights are often featured in the media. Dale is a regular speaker on our webinars, as I said, and always gives huge value. And it gives me huge pleasure today to introduce you to Michael Bellini. Mike has over 11 years experience in the property industry. He's a qualified chartered surveyor and has been a member of the Royal Institute of Chartered Surveyors since 2014. Throughout his career, he has worked in various sectors and has gained specialist knowledge in commercial and residential real estate, as well as land and development. We're delighted, absolutely delighted to present Mike as our own in-house chartered surveyor. Welcome, gentlemen. So Dale, if I can hand over to you and you can take it away with the slides, please.
Brilliant. Thanks, Lynn. Thanks for the intro as always. Great to connect and see everyone. Thanks for taking the time out. We appreciate it's coming up to Christmas and holidays and everything else. So yeah, we're going to be recording this anyway, but thanks for those joining us. There will be definitely some very useful insight, and hopefully this will help you with your decisions for next year and whatever you decide to do with regards to property. Yeah, we do a lot of market research, as you know, with various leading markets. So yeah, we just wanted to update you on what's happening in the UK housing market. So just a bit about us. Fabrik Invest has been around now for a while, about several years. We've recently expanded. We've got a team now of aftercare consultants, purchase progression, Mike himself being a qualified surveyor. We tend to focus on prime locations for capital growth, where there's a lot of regeneration and scope for capital gains, but also good rental yields. And we focus on good quality build. We're getting build warranties. That all the certifications and insurances are in place, with an emphasis on sustainability and energy saving as well. We do provide lifetime after-sale support, so not just buying a property with us, not us sourcing your property, but actually the ongoing service is extremely important to us, as well as the security. We look at things such as location, due diligence, and also making sure everything stacks up from a legal standpoint, and that investors' funds are as secure as possible. So integrity and ethics as standard. So again, a combined experience of 100 years between myself and the team. We've got a dedicated office based in the UK and London. We've got an office now in Cape Town, and we are looking to expand in the new year to where our investors are primarily based, whether that's the UK, Middle East, or Asia. We provide a tailored and bespoke service, expert insights. We often produce free property guides. If you're on our mailing list, you should be receiving them. If not, obviously, check with your consultant and click send to safe senders list, because sometimes it starts to go into the spam folders. But we give really free, insightful, free information at no extra cost to bring you up to date on the market. Our services are fully comprehensive, from mortgages to tax advice, to legal support, and right through to the completions, furniture packs, and property management. Everything's taken care of in-house. Our prices are direct from the developers, so we don't sort of charge any additional fees on the prices, and we usually negotiate a bit of a discount and some good deals on the property as well. We're fully regulated by the UK Property Ombudsman, which is the official redress scheme, which means we have our professional indemnity cover, as well as the Office of Fair Trading Standards and the RCO. So in terms of trust, we pride ourselves on customer support and going the extra mile for our customers. Don't take our word for it. You can go onto our Trustpilot today. We've got all genuine reviews, and we're proud to say that this year and historically, we've got the best reviews as a company on Trustpilot. So when doing your due diligence, I'd always recommend whatever agent you're buying with, that you do go and check their Trustpilot and check reviews online, just to make sure that there's no negative or poor experiences that any other investors are having. So just to bring you updates on the UK housing market, there's been a huge amount of activity this year. House prices have increased on average 6.6%. I was reading the latest Zoopla housing reports. They're expected to grow by 6.9% to the end of the year in terms of the average. The Northwest is leading the growth in England, so cities such as Liverpool and Manchester still topping the list for capital growth, as well as cities such as Wales, Ireland, and some of the smaller towns such as Preston and Blackpool. Buyer demand is up 28% compared to the 5-year average. So this is all stats from Savills and Zoopla. So during the pandemic, the housing markets continued to perform very well to date, with a record number of sales ever seen since 2007. So whilst the pandemic certainly has had an effect on the economy, there's been a shortage of sellers to the market. And as a result, buyer demand's increased because people are moving, maybe looking for a bit more space, or moving to different areas or cities, but also taking advantage of record low borrowing rates. On that front, Mike, I mean, as a Royal Institute Charters of Surveyors, your experience, what do you think is causing this pent-up demand in these regional cities in the Northwest, based on your experience, Mike? What are your thoughts?
So from what I'm seeing, I'm actually sitting in the Northwest at the moment, in Blackpool myself, actually. I'm sort of always in the Northwest. Always known for having low purchase prices on properties, which has then resulted into high yielding assets. And that is always something I push to all of my clients. But I think some of the big things at the moment I'm seeing is like major real estate firms, like the likes of Savills, are reporting high forecasts for capital prices to increase over a certain amount of times. And I think when companies such as Savills are saying this and forecasting it, then people stand up and listen. But I'm also personally seeing is that what we've had is a pandemic. We've all had to work from home. We've also seen the low interest rates, and that means that people have had more money in their back pocket, but they've also seen that it's not earning them any money in the banks. So they're seeing inflation rise and thinking it's best to put it into property. And what I'm saying to my clients at the moment is for them is to purchase high yielding assets in the Northwest so they can actually make the most of their money.
Excellent, excellent. So for me, I think what it is there's been a further shortage of supply of housing coming to the market, with demand being, obviously, I was reading an article earlier. I mean, the Bank of England are talking about 50-year mortgages now for first-time buyers. I think that's going to continue to drive the house prices up. You've got Lloyd's Bank entering the private rental sector. They're investing millions into housing. So there clearly still a shortage, and I guess people are still continuing to purchase. And with the shortage of supplies and COVID restrictions, I think that's further fueled the shortage of supply. So yeah, we'll move on to the next slide. Closing news for 2021. If you look at the graph here, this is the prices since 2001. Demand in mid-September 2021 up 28% compared to the 5-year average. At the same time, the stock of new homes is 38% below the 5-year average. So if you see this light red line, that's the price increase. You can see it jumping up fairly significantly. So some market jitters sort of at the start of the pandemic, slight dip, and then gradually we see the spike in the average UK housing price across the UK. At the same time, supply, because of inflation, I guess, and supply restrictions, less new build coming to the market, supply levels have dipped, and that's probably more than likely what's putting up the house prices. So what do you think, Mike? Why is there less supply coming to the market? What's fueling the increase in the house prices, in your opinion?
So from my review, probably in the last year, it was quite an interesting one, is that, yes, there's probably a lack of supply, but I think it looks like there's a lack of supply because there's such high demand for property at the moment. I think a big play at the moment is external circumstances, the likes of the pandemic and even the rise in unemployment. So you're seeing people who might actually hold on to their properties, and that's a major player for me. I think a lot of people don't know what's going to happen in the housing market so much in the next year. So they think, oh, I'll hold on to it. But I think the key thing for people who actually themselves are, I'm not sure about my actual situation in the next year. So it's holding on to their property is something they're looking to do. But people who are actually more keen to actually go and sell for their properties are actually they're selling for greater prices. And that is because of demand at the moment.
Sure. Yeah, so record low borrowing rates, pent up demand, shortage of supply to the market. As with any investment, it's all about demand and supply at the end of the day. Probably next year, it'll gradually, I think supply will slightly increase. Probably people will want to profit on some of the gains made, I guess, and take advantage of the current market. But for now, we're still seeing house price growth. So yeah, we'll move on to the next slide. Closing property news for 2021. On rentals. So rents, we're also seeing increases according to Zoopla's latest report. We're seeing 4.6% increase in rents. They're expecting 6% throughout the year. Monthly average rents around £968. So UK rents are rising at their fastest rate for 13 years. I guess that's generation rent. A lot of young people, unfortunately, can't get on the property ladder until they've saved enough for a deposit. I personally think there's a debate earlier on whether you should rent or buy a property. I think it's crazy if you've got the money and you can afford it. The best decision I ever made was to move from renting property in the UK to buying my own apartment. I now rent that apartment out. It's commute to about London. I'm getting about £1,200 rent a month. My mortgage is about £500 a month. That's an additional £600-700 in my pocket, which actually helps to pay my mortgage for my house that I live in. So, a lot of people say cash is king, but I think when there's negative interest rates, it makes sense to invest in rental property. So on that front, again, not only prices going up, but also the rents. I know you deal with a lot of letting agents up north, Mike, in particular, sort of the Northwest and Blackpool. We've got a portfolio within Fabrik Group as well, and I know you get involved in that. I mean, what do you think's driving the rents in these cities? across the UK?
Well, I think there's a couple of points. I think you hit the nail a bit on the head there, is that people nowadays can't move out until they're probably in their late 20s, and that is just because of down to saving and house prices going up being one. But also, you're finding if you were to look on the likes of Rightmove or Zoopla, there is nothing available to rent. And once again, this is the supply issue, which means that when you do have a property come available to let, there is a lot more demand for people who want these properties. And it allows the landlord to actually charge a little bit more because they know they'll have 5-10 people through the door. I kind of put that once again down to a bit of external factors. With mortgage companies, interest rates, it is a great time for people if they want to rent and they're looking for properties. A landlord themselves can charge more. And what we're finding up here in the Northwest is that we actually can then pick the quality of the tenant, which actually benefits our clients.
Excellent. Brilliant. So as a company, we actually, we invest in property ourselves as an asset class, compared to stocks, market shares, cryptocurrency. I mean, I've tried it all, and I think property for me still makes the most sense. So as a company, we do also invest into these projects. So yeah, onto the next slide. The latest Zoopla housing reports, which we're able to provide you. Just some of the key areas we focus on. We've got property investments in Liverpool. We've seen house price, according to the latest house price index, prices have gone up 6% on average this year. Newcastle also leading the way, number 2, 6.1%, followed by Birmingham, Manchester, and then London, but more the case of commute about London areas such as Kent, the southwest, southeast of London, areas which they have space, green parks. People can get more for their money, but still commute into the office. Naturally, with the hybrid working model, a lot of people are working now between the office and home due to COVID. So I think that's shifted away from the stigma of having to actually live in London, rather being able to live in an area outside and get a bit more space. So that's, I think, what's also affecting the rental market, in my opinion. On the housing price index for Zoopla, again, Liverpool at one of the number one spots at 10% growth this year. Manchester at 8.7%, and Birmingham 6.1%. Newcastle at 4.7%, and London at 2.3%. And the UK average across the UK 6.6%. Market outlook for 2022. So according to the latest Savills house price index, 4.5% rents projected to rise in 2022. House price average at around 3.5 to 4% increase. I mean, they regularly forecast at the start of the year, but by the end of the following year, we're finding the forecasts have gone up. So these are fairly conservative, and 4.5% expected house price rise in the Northwest. Naturally, the stamp duty holiday has ended recently. So with that, the market, people thought it would slow down with that, with the upper stamp duty saving, but it continues to be fueled by low borrowing rates. And according to KPMG, they expect those rates to remain low for the next 2 years. Naturally, investors do need to be careful fixing your mortgage rates and benefit from low borrowing rates while they're still low before they do decide to increase the rates. So why is now a great time to invest? I mean, we think basically, if you look at the graph at the bottom, there's higher job vacancies, which has led to, obviously, unemployment has been an issue during COVID, but there has been a rise in employment. Salary and rental demand will continue to drive yields. Higher salaries lead to more affordability for renters as well. And then we've got a forecast here on the home let rental index in green, and then the Zoopla new lets in sort of red, and then on the orange is the Rightmove stat for the new lets. So again, we feel that there are certain areas which will perform better than others, and that's why due diligence is key, and making sure you do your research. And checking out what's actually happening in the market in terms of demand and occupancy rates. Onto the next slide, KPMG. So we've read the latest KPMG forecast. UK economy is due to reach pre-pandemic levels by Q1 2022. Savills, meanwhile, forecast a rise of around 3.5%. The long-term outlook from Savills, they expect prices in the UK to increase by 18% over the next 5 years, and in places such as the Northwest by 28%, Yorkshire, Wales as well, and Scotland performing strongly. According to Zoopla, rents in 2022, again going up, and the long-term increase on rents over 5 years, Savills expect 19.9% in certain areas across the UK. So why is now a great time to invest? The UK's pandemic recovery rate is still in effect. If you look at this column here, this is your expected economic GDP. So it has started to bounce back quite strongly. This green line here from sort of 2008 until now. As you can see with the pandemic, there was a massive drop in GDP, but that seems to now be increasing. And yeah, there's a really good article online that you can read on that. Which is the latest KPGM reports, just talking about the UK economy and how things are performing. Obviously, there's been restrictions. As restrictions are lifted, consumers are flocking back, retail's opening up again. Naturally, it has been affected, but the short-term outlook for the economy is favourable. Unemployment's relatively low. The outlook for the economy, I mean, the worst part of the crisis is now likely behind us, and with the vaccination program well underway, we expect rapid acceleration in growth this summer. Forecast rest on the assumption that the government restrictions are, of course, lifted, and we don't go back into any sort of, hopefully, unnecessary lockdowns now that the vaccines have been rolled out. Obviously, that's also subject to new variants coming to the market. So UK average house prices set to a record high. I mean, from your perspective, Mike, in terms of house valuations, maybe if you just want to touch on what RICS actually means. A lot of our investors are from overseas. You know, what does that mean, and how do you guys value the property market in the current environment, and what are the challenges at the moment? So,
yeah, the Royal Institution of Chartered Surveyors, this is a professional qualification that takes quite a few years to qualify for. Now, what I've been able to do is qualify as a general practice chartered surveyor. Now that you can practice in lots of different in lots of areas you can practice in. I've been involved in valuation. This is a key thing for what we do at Fabrik Property Group. Now, although we don't provide our own residential and commercial valuations, because we are the selling agents, when we do value properties, we need to ensure that we are looking at lots of different factors. We're looking at the location of the property, which is very important. What are the comparables, sales, which we always ensure that we provide these in our packs to our investors. And we need to ensure what the pound per square foot rate is, what the demand is. All of these factor in to ensure that we are finding the right value of these properties before going out to sell to our investors.
Interesting. So are you finding at the moment, in terms of house prices, do you feel that there's a shortage of new build coming to the market, and you know what factors are causing less new developments to come to market?
So yes, I would agree that there is a shortage of supply, but I think that is probably actually going down to maybe not valuation, it's probably actually going down to, once again, external circumstances of developers trying to build and trying to get the good stock, the stock in from maybe overseas due to the pandemic. But then that supply actually then drives our demand, and we're finding we have a lot of investors waiting for those developers to complete their builds.
Yeah, I think a construction market has been fundamentally affected by build costs. Build costs are going up, but that's supply chain. I think inflation as a whole is going up, but it will probably be more sustainable in the new year. One would hope, now that things have opened up again.
And I think that's why, even though the build costs are going up, you're finding good quality developments like the ones that Fabrik Invest have are being completed, and we are being able to offer these good quality yields, which obviously that's what the investors are looking for, to use their money. So because of the rise of inflation, and obviously interest rates being at an all-time low.
Agreed. I think what's happened as well, the Bank of England, no doubt, and the government's having to print off more money. Quantitative easing means the value of money itself is not what it used to be. I mean, you know, there's a saying that goes around that cash is trash, and I've always said it's always good to have money saved for a rainy day. But you know, if you've got 40, 50, 60,000 pounds doing nothing in the bank, you can currently get borrowing rates at 2 or 3%. Buy a property, put a tenant in, and get your mortgage paid. Then you know, that's, to me, is good debt, and it makes perfect sense. So that's the UK market, very resilient. I've invested in the UK, but I've also invested offshore, and I must say, the UK properties has definitely performed a lot better than the properties in Brazil or Philippines or South Africa, where I've invested as well. So
just to point out there, Dale, a lot of my investors at the moment are actually from overseas, and they're finding actually that the yield return in the UK is greater than what they're working on in either Europe or international. And I do think at the moment this is probably a great time for international investors to invest in locations like the Northwest, because there are good quality, high yielding assets there.
Yeah, absolutely. And not only that, I mean, there's more liquidity in the market for mortgages for international investors as well, which before most of the time it would have to be cash, but now there are lenders lending to buyers abroad, which has helped massively. So on to the next slide. I wanted to discuss diversifying your portfolio. Maybe you've already got a UK portfolio of residential properties and you're happy, but you're thinking now of diversifying into different assets. Market I've been following for the last couple of years quite keenly is the holiday market, short-term lets. There's been a massive uptake in staycations, 7.1 billion estimated UK staycation spend in summer 2021. No doubt because of lockdowns, people are saving more money at home, not spending as much. And as a result, spending more money on staycations. 22% increase in staycation spending, 73% of Brits likely to travel within the UK after COVID, and 2/3 of Brits took 2 short breaks in 2020. So places like Cornwall and Lincoln and all these great spots around the UK, people want to get outdoors, be in touch with nature, and especially when you're stuck at home or working from home. So massive demand. And it's a market we've been looking into. We've got a product which is luxury lodges. So just something different. If you are considering alternative assets, you can generate some very good yields in the region of 8% on in some cases on these types of short-term holiday investments. In your experience, I know we've got some service apartments and holiday lets, Mark, within the Fabrik portfolio. Do you think that a lot more Brits are doing staycations, and rather than getting on a plane and going to Spain? And what is your take on the short-term let market at the moment?
Oh, firstly, this is a market I really like. I think it's a very good market, and I think it will be here to stay. Yes, I also agree with your question, is that I was part in Blackpool quite a lot, dealing with the Fabrik portfolio and also speaking to investors on a regular basis in the summer. And I actually had to start my appointments at 8 a.m. so I could finish by midday, because you just could not get past the amount of people on their staycations. So the numbers don't lie on what you're showing. And I've actually been able to witness it and actually speak to people about it. And I think I read an article recently, and I think Blackpool was the highest rate of footfall by, I think, 120% in the summer for staycations, followed by, I think, the likes of Bournemouth and Sunderland and those areas. So I think this is definitely a market that should be considered, because even though you have these high percentage rates, and yes, you may be able to go on holiday a little bit more than you did last year, word of mouth is always important. And that amount of people going to these destinations will return because they've enjoyed themselves and actually found that they're relatively priced and don't need to pay the extreme prices which are going to be put onto foreign holidays going forward.
Air travel, of course. Plus, you book and you plan things, and then things change, and you don't know if you're going to be going on holiday, or being able to travel. So I guess there's definitely been a big increase. We're finding people also looking for even city break type accommodation in Manchester and Liverpool. Your occupancy rates averaging 65 to 75% a year. You're charging a nightly rate instead of a monthly rate. And there's companies now like Airbnb. We partner with a company called My Property Host, and some of our investors are getting 10% net yields on stock in Manchester on short-term lets as well. So, that's another market that seems to be doing really well, and there's various tax breaks as well, like on holiday properties. So yeah,
I'd agree with that. And with the likes of these holiday properties, people nowadays, the modern day people, don't always want to stay in hotels. They want a bit of their own space, and I think service accommodation really does offer that. You can almost get like your own apartments where you can wake up, shower when you like, you can eat when you like, and you're probably paying the same price, if not less, than a hotel. So this is a market I'm keen to be involved in a lot more. And like I said, the numbers don't lie. And I think this is why there's good products out there which investors should consider.
I guess having that space, private space in an apartment is also, instead of being in a hotel with loads of people, a lot of people now want to have that space with everything going on in the pandemic. So we've definitely seen a sharp rise in demand for properties. Most apartments can only be, in usual cases, new build long-term lets, but I am seeing more and more developers and management companies and accept short-term lets as well. So great, we'll move on to the next slide. Another alternative investment, which we believe is recovering, was adversely affected by the pandemic because students were studying from home, right? But I think these students are been at home, had enough, want to get back to their normal lives and having fun and enjoying their youth. So we are seeing a rise in students enrolling again into higher education at universities. 496,000 international students studying in the UK. It's always been known as one of the best places in the world to study. A lot of our clients often ask us, do you have property near Oxford or Cambridge or Liverpool University? Because they want to invest in property that their children can stay in, but that they can also then not fork out huge amounts of rents. So a record of 5.77 billion was invested in the UK PBSA market. We're seeing people return back to the campuses now that the restrictions have eased and the vaccines have been rolled out. So again, we do have completed options on PBSA, which is an alternative asset, lower entry prices, anywhere from sort of the 80K mark up to 100,000. And again, generating a 7% net yield on that sector. So another alternative market, which we feel is definitely one to look out for in 2022 as the market recovers. So just as an example, this is one of the alternative investments we offer. These are luxury lodges by a company we've partnered with called Live Lodges. It's become very popular, a lot of famous sports people and football professionals investing in it. They give an 8% net yield assured for 5 years. There's a buyback option of 105%, tax efficient, so things like stamp duty and income tax can be alleviated. I mean, we're not tax professionals, but we can put you in touch with tax advisors to let you know what the tax breaks are on these. You get 2 weeks personal usage. So we've currently got a really nice site in Lincolnshire. They've all got, they're done up really well with hot tubs and, they're about to partner with Sykes, SYKES as the operator, as well as Ho Seasons. So very exciting, unique investments, and it's simply just an income generating asset that's targeting the holiday market. Prices from 139K, but there are some discounts available at present. Second example on alternative investments is the student market. We've got a fully completed development near Lancaster University. It's got a 7% net return assured for the first 3 years, or guaranteed, and that's actually asset-backed as well. So it's an asset-backed guarantee. Prices from 87,000. It's completed, so that's going to give you immediate income, and they're fully furnished to a very high standard. So self-contained studios being rented with the local university students, and as a sort of university city, it is one of the most undersupplied markets in the UK. So definitely one not to look past, and definitely one worth considering. Our most popular developments at the moment, so as we mentioned, Silkmore Suites, student accommodation, you've got 7% net rental returns. It's asset-backed, close to Lancaster University, a 54% projected ROI over 5 years. That's taking into account your rent income and any potential uplift. Preston, another city that I've really been banging on about for the past 2 years, a huge amount of regeneration going on. They've got the Stonygate master plan, redevelopment of the city centre, the high-speed rail coming in as well from Birmingham. and London. So yeah, you can get 6% net rental yields. Exchange in Preston's a brand new development of high quality 1 and 2 bedroom apartments. An 81% projected return on investment over 5 years, and prices from around £134,000. Then Michigan Towers, this is the Media City. Landsec has just invested millions into the Media City, with the home of the BBC and the RTV and tech companies. So really young, vibrant part of Manchester. It's still a lot cheaper than Manchester city centre, but you can commute into the city centre within 7 minutes on the train. So again, highly recommended. Development is underway with the completion scheduled for 2024, but you can, in the meantime, choose the best units and expect some very good capital growth. That's an award-winning developer we work with, X1, who do a really good job in delivering the developments to good standards. So yeah, that's just 3 options that we could potentially offer you that we'd recommend. Without going into too much detail, you know, we do believe now is a great time to invest in property. It is a good time to buy in December, because admittedly, December is a bit of a slower time. So we're able to, because of our strong relationships with these developers, negotiate really good deals at the moment. Some of these investments save up currently free furniture, paid legals, bit of a discount. You know, you could be saving up to £15,000 by buying into these projects early. So to find out more about that, you can of course speak to your broker. Yeah, that's pretty much it for now. In terms of the buying process, very straightforward. Step 1, initial contact with your consultant. Step 2, your legal pack and contracts are issued by the solicitors. We can recommend a lawyer, or you can choose to use your own lawyer. Step 3, obviously all the checks and inquiries will be done on the contracts. You have to do anti-money laundering and all the usual to purchase. And the 4th step is to exchange of contracts. It normally takes about 28 days. With new build, of course, advantage, there's no onward chain or any hassle, so you can move forward fairly swiftly. You then got your construction updates if it is off plan, or if it's new build, you'll get your title deed straight away. And we'll keep you fully up to date with videos and updates on the construction side as well. So yeah, that's it from me, Mike. Is there anything else you wanted to add there, Mike, before we go to the Q&A, or any questions for me or Lynn? Or
no, I think you've covered everything. Obviously, we get these other opportunities in Blackpool, but I think that's something we can discuss at a later date.
Yeah. Excellent. I think there has been a demand. Just looking into next year, what we're looking at is we're seeing a lot of demand for stock in Liverpool city centre, commuter belt Manchester, not so much in the city centre anymore because of the prices. A lot of investment going into Manchester at the moment, as you can see. Places like Newcastle, we're currently looking at stock there, Newcastle upon Tyne, Leeds as well, and then commuter belt London. So there's been a rise in the demand for commuter belts around Kent, you know, around even places like further south in Croydon, areas like that, you know, where people can get a quick, easy commute, but pay a lot less and get a higher yield than central London. So yeah, so that's kind of what we're looking at. And then of course, potentially alternative investments as well, for any investors looking to diversify their portfolios. So yeah, thanks very much. I'm going to move on now to Q&As. If anyone's got any questions, I'll let you take the mic, Lynn. Thanks.
Lovely. Thank you. Thanks, Dale and Mike. Always extremely informative, massive value, and very much appreciated. I know these 2 gentlemen particularly could talk about property all day long, so I do appreciate that you both just kept it to half an hour, 40 minutes there. That was probably pretty tough for both of you. They do both like a conversation, I will just say. So if you've joined partway through, please don't worry. Just a reminder, you will receive the recording via email, so you'll be able to watch it back. I'd encourage you to do so. Lots of information in there. I'd certainly like you to invite you to stay on. If you've got any questions, please do put them in the chat. And if you can save your questions for Dale or Mike, I'd really appreciate that. We've got a few coming in already. I'll go to those in a second, but do remember that if you stay to the end of the Q&A, which should only be sort of 5-10 minutes, we're going to give away a free gift at the end. So just to move on to the questions then, firstly, Many of you are asking me if you'll have access to the slides. So yes, I think we can get those out to everyone, can't we, Dale?
Yeah, no problem at all. That's
Excellent,
absolutely
thank
fine.
you. Lovely. So a couple of questions then. First of all, how will inflation affect investments and the demand for materials and builders?
It's a good question.
Dale, would you like to take that?
Yeah, so it's no secret or anything. Inflation's gone crazy. Build costs have gone up like 20% or so in the last year, but that's mainly been down to supply chain issues because of the lockdowns. I believe whilst the supply chains resume to normal, inflation may come down slightly. However, costs of living have gone up. The price, everything's gone up. So the same has happened to supply materials, concrete, wood, everything. So that's affected feasibility of bigger projects, so like these, big tower blocks and things like that. Developers all of a sudden like, well, is it viable? And a lot of them are either holding on and waiting. But again, this has actually created a further problem on the housing market because there's less supply. So the government needs to probably do a lot more to help house builders. I do feel for them because of the cost of materials going up. How will this affect investors? I think, you need to be smart about the price you're paying. So you need to make sure you do your due diligence. Make sure that the contractors do have in sort of fixed build contracts. A lot of the stuff we're offering is like commercial to residential, for example, or developers who've already got fixed costs from 2 years ago. Anything that's coming up overpriced, in our opinion, we're not going to launch it because it's not a viable investment for our customers anymore, based on our research and market comparables. So yeah, it's affected the market, I think, in the short to mid-term, but I am hopeful that build costs will stabilize over the next year. Mike,
Perfect.
anything on that one?
No, I think I would actually agree with you, Dale. I think being in the mix of development myself at the moment, I've seen build prices go up very sharply, very quickly, and I think that's where I say to my investors at the moment, just think about what you're doing, and make sure that you've got your comparables and you've got your builders set at the prices, because it will level out, and it is just the sharp increase of trying to get materials at the moment. Once we come out of this pandemic, things will then come back slowly back to normal. So my advice at the moment is go for higher yielding assets which are working to beat their likes of inflation and have the lower interest rates, instead of putting going into development for the time being. Yeah.
I know the latest KPMG report does say UK inflation is starting to return to normal. So obviously the cost pressures on raw materials and energy prices, a result of COVID, also Brexit, a double whammy really, but they are expecting inflation to hopefully normalize from current rates. So we'll see there is a recovery in oil prices, which will continue to boost inflation over the summer. Global supply chain shortages and high commodity prices, obviously leading to rising cost pressures, and other factors to consider. But the Bank of England is likely because of this to raise interest rates, which means now is a good time to leverage, right? So absolutely. At the same token, there's always positives and negatives to the situation.
Thank you. So guys, can I just say to you, I think you can all gather now what I said about these two wanting to talk all day about property. So that was just question one. So okay, if I can ask you to, there's a lot of questions coming in here now. So I would like to get through as many as we can whilst we're on the webinar, because of course it does benefit everybody to get through them whilst we're here, as opposed to going back to them at the end. So moving on, for students, just talking about the student property market, would you invest then in a one or two bed flat, or would you go more down the road of a mini HMO? What's your opinion on that?
Depends on your strategy and how involved you want to be. If you want to be more involved, then HMOs could be a good option, but it could be a lot of hassle as well, when things get broken and damaged. PBSA has always been popular for us. That's your purpose-built accommodation with it's almost like a hotel for students, let's say, with communal spaces. They've got workspaces as well where they can work on their projects, but also have their own private space with a little kitchenette and a bed. Now, that tends to yield the highest because those are lower cost. A 1 and a 2 bedroom is a great idea, students sharing, and it can be profitable, but there are downsides to sort of doing it yourself or going for the fully managed PBSA sector.
Perfect, thank you. And the risk of additional delays, you know, for example, we've seen that ourselves with some developments. So what do you think about the risk of additional delays with things?
For me or Mark?
Yeah, both of you.
Either. Yeah. I'll go quickly first. There's been a bit of a knock-on effect on some schemes, again, because of supply chain issues. But ultimately, you know, at the end of the day, it's manageable. We're talking sort of 3, 4, 5 month delays. There's usually long stop dates in the contracts which protect clients as well. So often most of our projects have a 1 year long stop date. The developer does go over that date, you know, you can get a refund as well. But we haven't seen a huge effect on knock-on delays, typically 3 to 6 months because of COVID.
I'd agree with Dale. I think, to be honest, as long as your broker or your consultant who you're dealing with keep you up to date on it, I think it is expected that there is going to be delays given the pandemic. And to be honest, in most times before the pandemic, there's always sometimes a form of delay. So as long as you're kept up to date by a consultant, I think that on a daily basis or a weekly basis, then that should continue and you will then get the property once it's completed.
Yeah, and that's something that we certainly pride ourselves with.
Absolutely.
We have a unbelievable after sales team, and yeah, we like to keep our clients updated. So another question here: will the price increase and rental demand slow down or have some form of correction? If so, do you have a prediction for timeframes? Dale?
All the market reports and the fact that the Bank of England has just announced they're going to be doing these 50-year mortgages, and you know everything they're doing is to keep the markets stabilized. Naturally, it's going to have to cool down at some point because it's probably risen faster than expected the last year or so. And again, it depends on you houses or apartments or different types of properties, different locations. But ultimately, if you're not buying to speculate short term and you're thinking medium to long term, even if there is a slight house pricing correction, you know, anyone who bought before the recession, as long as they waited it out and didn't sell during the recession or the pandemic, they're going to do well. So property is a medium to long term investment, in my opinion. And if you buy it that way and you think that way, then, you know, even if there is a slight price correction, I think you should be okay.
Absolutely. And Mike, have you anything to add to that one?
I couldn't put it better anyway, really. I think Dale's hit the nail on the head, is that property is a medium to long term thing. And even if you think there's correction coming, people have said this for years, but we're seeing forecasts from major players saying that there are going to be increases constantly. Maybe it will cool off a bit, but I don't think that should allow you from stopping to buy from speculation.
Yeah, there's no sign of any cliff edge in demand. A lot of investors have been waiting, saying no, they're expecting a fall, a sort of cliff edge fall, but it's not happened because there's not enough supply in the market.
I'd argue they're starting to miss out as well because they're waiting for so long.
Yeah,
absolutely. A very similar question here. With interest rates rises likely, what impact will this likely have on property prices and demand?
I think there'll be a slowdown in the rate of price inflation, which is probably not a bad thing, because you know we do need to make sure that the youth can still afford to get on the property ladder at the end of the day. But I think it's going to be very gradual. And from what I'm reading in the latest reports, they're not going to just all of a sudden raise the interest rates, because it would be crazy. It would just be, I mean, it's going to be very gradual, you know, probably 0.25% and then another 0.25 in a year or so. So I wouldn't expect interest rates to go up much in the next 2 years.
Lovely, thank you. Just a bit of feedback here. Somebody's saying excellent answer from 2 experts. Thank you very much. So that's good. It's always good to have a bit of feedback live on air. So lots of questions. I will just say we're not going to get through all these because we did stipulate we just wanted to keep it to the hour. I'm just going to do one more here. or just a couple? No, because I can see another interesting one. What do you think can be done to help young people get on the property ladder?
Simple
Either
answer.
of you?
Do you want me-
Yeah, affordability, obviously building more affordable homes for first-time buyers. Continued government initiatives to help them get on the property ladder. Tax breaks, such as the stamp duty tax break, that was really helpful. And then also just, yeah, I mean, they've just announced 50-year mortgages. So if you're in your 20s, I mean, you know, just depends. But if you're young and you know, and you want to get on the property ladder, if you can get a 35 or 40 or 50-year mortgage at such low borrowing rates, why not? So I think they already are doing this. But yeah, that's my thoughts anyway.
I think with the sort of the introduction of like 5% mortgages, and I think if you look at young people, they now can actually sort of like partner with family members as well. I think this gives them a greater option. Looking at new build stock as well, that actually helps the property market in general, because new build stock is mainly the stock which allows for first-time buyers to get the incentives. So therefore they can purchase at greater rates, which means the housing market continues to rise and therefore demand stays, and then new homes continue to be built. I think it's a very good circle what the government do, and that's why we'll see more homes be built and house prices will slowly increase year on year.
Yeah, I'm seeing there's an article here actually in thisismoney.co.uk. Bank plans 50-year home loans. Bank of England to relax mortgage rules to help first-time buyers in a move that could potentially send house prices soaring. So I get what they're trying to do, but they need to do it the right way, because what you don't want to do is just prices continue to go up. But then there's mobility as well. There's a hybrid now of work from home and work from the office. So I think a lot of people are looking at cities like Preston and saying, well, I could live there quite comfortably for a lot less. And that's what's driving the demand for these cheaper, more affordable cities and towns in the UK.
Absolutely. Okay, guys, I am actually going to close it there because there are a lot of questions coming here. I think we could probably fill another hour with these questions, but I do want to move on. I do want to keep it, as we promised, to the hour. So I'm going to bring the Q&A to a close, but thank you very, very much. Dale, if I could just hand over to you, and if you could tell everyone what the free gift is today, please.
Sure. So we're just finalising the Q4 property investment market report, as well as the outlook for 2022. So all this information and research and due diligence we've done will be jam-packed into this the guide, and that'll basically just cover everything we've discussed in more detail on the housing forecast. We're also going to be doing something which I thought would be very helpful. We're putting together an investor checklist. Now, this checklist will basically tell you what exactly, so we've got a 150-point checklist, but we're going to summarize it and simplify it, what to look out for in terms of the due diligence steps if you're planning on investing in new build or off plan or whatever it is. And the third one is, if you are interested, you can get a free one-to-one strategy call with one of our senior consultants. They've all got sort of 10 years plus experience. We've currently got some very good deals on the go with some of our developers, free furniture, paid legals, and a discount off the price. If you're looking to sort of get in now before the end of the year, there's some special offers available. So yeah, those three, I think I've covered it, Lynn. I don't know if I've left anything out, but yeah, that's it.
Do you know, I always lean in here and I'm typing because I'm thinking, again, you've thrown in more than just the one. I think actually up to 3 or 4. If I remember correctly, correct me if I'm wrong, Dale. So we've got the UK latest market report for 2022. If you would like a copy of that report, then please, what should we go for? Just put report in the chat now. If you'd like the investor due diligence checklist, I think you said, then just put checklist in the chat now. A free consultation with one of our consultants. As Dale mentioned, each of them have got over 10 years experience. Please just put one-to-one or consultation, or we'll know what you mean. We'll know what you mean. And also, I just wanted to remind people here that we do run a referral fee fee program. So please feel free to share our information and the recorded webinar with anybody, and of course speak to your dedicated sales team member for further information on our referral scheme. So also, if you've got any further questions, speak to your sales consultant at Fabrik. We'll be more than happy to schedule in a call with you. So I just want to bring it to an end now. Dale and Michael, just on behalf of everyone here, a huge thank you for your time and valuable knowledge today. Very, very much appreciated. I think we'll probably do something along these lines again in the new year. As I say, there's a lot of questions coming in here, so I think we could afford a longer webinar to this one. But thank you all again for being with us today. It's truly, truly appreciated. Also, just really a huge thank you from everyone at Fabrik. All of us wish you a very, very Merry Christmas, a happy, healthy and prosperous new year in 2022. Look forward to seeing you all again. So thank you very much. Take care, everyone.
Thanks, Mike. Cheers, Lynn. Thanks, everyone.
Bye-bye.
All the best.
Bye.
Cheers. Thanks. Bye-bye.
Thank you. Bye-bye, guys.